The biggest reason traders struggle with this psychology is that they lack proper confirmation inside of their key levels. So if you trade support and resistance, supply and demand, smart money concepts, ICT concepts, I want you to pay close attention to how I use order flow at key levels. So I only rely on 3 basic concepts: what, where, and why. And I've packaged this into a triple X model that allows me to find trades with high levels of precision in less than 90 minutes a day of screen time. So if you're interested in this, I suggest you take a notepad and pen, grab a cup of tea, and get ready for this video. Traders, welcome back to the channel. So in this video, we're going to be going over ICT concepts mixed in with order flow. So the reason why ICT concepts alone, I refer to them as repackaged pattern trading, is because there's no context as to what's going on. So the market itself is a derivative of 2 concepts, right? Buyers and sellers, which is order flow, and supply and demand, and they work hand in hand. So your job is to understand where the buyers are getting in and where the sellers are getting in, and then take advantage of that. So here we have ES on the 15-minute chart, but we're going to be combining the beloved ICT concepts in this video, right? So when it comes to ICT, the only thing I really use is I start off by using the Asian session, right? So we're going to be going over essentially this key level down here. So this is a key level, and we're going to be going over why that's a key level, and we're going to be going over this key level over here, right? So why do I use ICT concepts? So ICT concepts I like to use the Asian range. I'm not saying this is an ICT concept, but I learned it myself from ICT. We want to look for the high and low of the day above the Asian range. So we're looking for price to take out the Asian high and target the Asian low, right? That's one example. Another example of an ICT concept I think is quite useful for traders to know is the concept of the power of 3. So the way that the power of 3 works, very simply, it's quite a simple concept to use. If we take a look at this key level over here relative to the Asian low, it's significantly below the Asian range low. And so if you look at that, price is taking out the Asian low, and we're way below this daily opening price up here. So when you're below the daily opening price, that means you should ideally be looking for buys, right? Because you're below the daily opening price. That is basically how ICT works.
Connection lost.
Proper strategy per se. But with that being said, we're going to dive into how you can use this strategy to your advantage. So let's take a look at the key level over here. So this is a key level in itself, right? So notice how the key level itself, we see a breaker structure over here, and we're looking to trade off this fair value gap. So we need to understand a couple of things, right? Key levels themselves are essentially in charge of the market, right? Key levels is what determines whether a market is going to hold, right? So we want to understand the reactions at point number 1, and we want to understand the reactions over here at point number 2. So obviously my pen's not working, right? So let's quickly go into this. So on the ATAS platform, let's bring this up. ATAS platform. So on the ATAS platform, I have popped up the same key level. So this key level is responsible for creating the opportunities in the markets that you see. So let's start over here. Actually, no, let's start over here. Let's quickly break down this trade. So this was a sell-off trade post FOMC. Now, when it comes to ICT concepts, I use the Asian range, and I use specifically previous day highs and lows, and I think they're one of the most powerful concepts. And it's very easy to use previous day highs and lows. What you're essentially doing is once price takes out the previous day high, you're then looking for price to target the previous day low at a key level. This is important to understand. You want to be at a key level in order for these trades to actually work, right? Another thing about the PO3 is, of course, once you have price giving the weekly high, so the high of the week, you then want to be looking for, yes, a previous day high sweep, and you're looking to trade off these key levels. So the tip I want to give traders is you want to kind of extend your key levels all the way to the right. And once you've done that, you want to see how the market is interacting at all of these levels, right? How is the market flipping and flopping near these levels? And we are going to be breaking that down. So with that being said, now let's kind of break this down in a bit more detail, right? So here we have an ES chart in front of you, right? Now we want to see how the market reacts on the ATAS platform, right? So this is the ATAS platform I use for order flow, and we can see the same price action, the same key level has been marked out. But now, what's interesting now is I'm going to stop and I'm going to ask you a question, right? When price comes into a key level, how do you know whether to buy and sell? What gives you the indication to be buying or selling, right? Fair value gaps alone are not the answer, right? Liquidity sweeps alone are not the answer. Time and PO3 alone are not the answers, right? there's something you need in your trading to make it work, right? So we're going to be breaking that down. So extra confirmation comes from using the footprint charts, right? So by using ICT or smart money concepts or any of your trading with order flow, indication as to what's going on at key levels. Okay, so let's break this down. So my screen is frozen, but we're going to make this work. So let's kind of dive into the charts over here. The ATAS platform essentially gives us the indication as to what's going on at key levels. So we're going to be breaking this down candle by candle on the 15-minute time frame. And just so you know, this is point number 2 over here, right? So this initial sell-off, why did it happen? So let's say you take a short position just below this zone and you want to have your stop loss just above the zone over here. The ATAS platform will tell you how to do that. And so when we kind of dive in, I'm going to give traders a masterclass on how to read footprint charts and order flow. So what we can see here is we can see a green candle. Now, what's super interesting when you dive into the candles is this, right? So the left number is the bid and the right number is the ask, right? So you have the bid and the ask. The bid represents, so the number you see represents the total number of contracts hitting the bid, right? These represent, aggressive sellers, right? For basic knowledge, these are sellers going in at market prices. So what I mean by market prices is that if you look at the price on the left hand side over here, what you can see on ES, if I bring this up, what you can see on ES is you can see at this rough price point over here, so that's going to be 64.28, 64.29, 30, you can see a lot of aggressive buyers and sellers. So you see a mixed signal going into the zone. So at this point, I'm seeing a lot of buying, a lot of selling. I'm staying cash. The reason I want to say cash here is because if I see both aggressive buyers and sellers both being aggressive, it's showing me that there is no absorption. And we're going to go over what an absorption is, right? When you're looking inside of a key level, you want to see an absorption, in this case, of buyers, because you want to be selling off this supply area. Demand flips to supply, sorry. You want to see buyers being absorbed. So you're looking for heavy positive delta. So what I mean by positive delta, and why is positive delta so important? So let's take a look at this. We see 0 for 80. Right? That means the ask, which is the right number, minus the left number is going to be, in this case, 80. The reason for that is because there's 80 aggressive buyers and there's no aggressive sellers. So as a trader, what that means is at the price 64.30 exactly, so basically entering the key level, at 64.30, there were 80 aggressive buyers going in, hitting the ask. Perfect. And you can translate that to all the other rows. So when you see 1K times or 1K for 2K, that means that there's 2,000 aggressive sellers hitting the bid. Perfect. Now, as we go into this kind of key level, right, what you can see over here, without even looking at obviously the candle is going to be green as price moves higher. What we're seeing here, interestingly, is you're seeing a few things, right? You're seeing, this is the delta profile. This is what's called the delta profile. The reason the delta profile is important is it shows you the difference in the delta. Now, the delta is defined as the right minus the left number. So it's the ask minus the bid. So when you see a lot of positive delta, so this candle here is overwhelmingly positive delta with a few negatives at the bottom. When you see positive delta, the way you want to interpret that as a trader is at these prices over here. So 64.31, 32, 31, round about here, there's a lot of buying volume. There's a lot of buying activity, right? Buyers are trying to push price higher. They're trying to break a level. So how do you know that a short position is going to be valid, right? How do you know a sell position is going to be valid, right? So the way you know that is because you want to know essentially sellers are in control at this area. So when we kind of break this down, over here, sellers must be in control before the market tanks off, right? Sellers have to be in control. And so you can read that only with the footprint charts. So this is where it gets interesting. You want to look at all of the behavior and all of the activity just above the key level. And here you see an overwhelmingly amount of positive delta. In fact, when we read some of the candles, right? When we read some of the numbers, 0 for 27, 231 for 494, 500 for 800, 761 for 826, etc., etc. So we're seeing a lot of red delta. Now, blue delta. When you see a lot of blue delta and then the market fails to break above the level, because we haven't broken above the level. Notice how we have a wick and we have a wick. So this is how you use candles the right way. Using a wick rejection, a hammer, or any other pattern is simply not viable when you come into a key level. What you're looking for at a key level is you want to see whether it's going to be a demand or a supply zone. Whether it's going to be a holding bullish fair value gap or a holding bearish fair value gap. Because notice this key level, if I just go back on the charts, notice this key level was actually formed off a bullish fair value gap, then it flipped to supply, and now we want to know whether supply is in control, right? Is supply in control? Are the sellers in control here the same way they were over here at this price? So this is around 64.30, 64.33, round about this area. The answer is yes. And the reason why it is a supply area is because aggressive buyers have failed. And so when aggressive buyers have failed, it's showing you an absorption. So we see on the 15-minute chart, probably 15, 30, 45 minutes of absorption, right? Aggressive buyers are failing. Another thing you want to look at is the zero prints at the top, right? So we see 0 for 40, 0 for 27. What do the zeros represent? Now, zeros are a very strong indication of a reversal. And the reason I say that is because you want to interpret literally what that means. So at the price point, this is now going to be between sort of 64.34, 64.35, round about this region between 34 and 5. What you need to understand here is when you see these zero prints over here, these zero prints represent the fact that there's no aggressive sellers, right? There's no bid volume here and here. There's no bid. There's only ask volume. So just with that in mind, if you see a lot of positive delta and you see these two zeros over here and you see a big red candle and a second very large red candle, you see two massive red candles and a break below, very aggressive break below. What does this show you about the price? Well, it shows you very simply that the aggressive buyers all the way up top have failed to break below the level. It's that simple. So by seeing this, you need to be patient to wait 15, 30, maybe up to 45 minutes, depending on the trade. Some trades a bit less, some trades a bit more. But you need to be willing to be patient to wait for price to hit your key level, wait for price to show you the confirmation at the key level, and then be confident to enter. So it's all about waiting, analyzing, and letting the market essentially play out. Those are the three things to make a successful trader. And the way you do that is through key levels, entries into the key levels, and order flow. So it's really that simple, right? And again, you're using ICT concepts, right? You want to be targeting essentially the previous day low. So ICT concepts do have their place, but they're not essentially a valid way to trade by themselves. Now from here, what's interesting is once you have that in place, you can enter, ideally you want to be entering close to the level, but once you see price breaking below, you can enter here at the level, you can have a stop loss here, and you can essentially ride the wave down to the previous day low, which is also that FOMC low, right? So from here all the way down to there, right? So that is how you trade key levels, right? So if you're a trader who's looking at support and resistance, supply and demand, ICT concepts, smart money concepts, you want to be interpreting footprint charts and order flow in any kind of analysis that you do. So moving back now to the order flow footprint chart, moving back to the regular candlestick chart. So what I want traders to take away so far from this video is that trading itself is not going to work unless you understand who is in control between buyers and sellers, right? So that was a bearish example. We want to quickly go over a bullish example to kind of finish the video as well. So we want to understand essentially what was going on just kind of here. We want to know what was going on here as well, right? So this was a key level and this was a rejection. Again, what makes a key level valid? Well, the only thing that for me that I look for when it comes to key levels is we've seen essentially a 15-minute kind of POI, right? A 15-minute fair value gap. So what we've seen over here is we've seen price, breaking structure. So we've seen price breaking to the upside and price leaves a 15-minute FVG just over here. So with that fair value gap in mind, how does the market react? So we see price wicking below, which is a good sign. When price cannot break below a level with a wick, it essentially means price is going to reverse. But we don't want to rely on wicks and candlesticks and any other patterns and fair value gaps alone. What you want to rely on is this. You want to have successful entries, right? The way you have successful entries is by understanding whether you're at a supply zone or a demand zone. So it's a shift in mentality. You want to go from saying, I will buy at this zone or I will sell at this zone, right? You want to move away from that mindset and you really want to ask yourself, is this going to be a supply zone? Is this going to be a demand zone? And what will price give me? It's a different shift in mentality. So as price comes down into this region, we are essentially looking for the opposite. So that wick over here, that very expansive wick, let's kind of break that down, right? So when you saw this wick over here, let me just circle that. So this wick over here, boom, right? We're going to be focusing on that wick. And so what was going on inside of that wick, right? And you can apply this to any time frame, any chart, whether it's crypto, forex, doesn't really matter. Over here, you saw a wick rejection. That was here. So again, you don't even need to read the numbers. You can just read the delta. And this is the advantage of using delta footprint charts on the A-test platform. It essentially gives you the exact number of market participants hitting the bid and ask, but you can interpret this from the delta. The delta is essentially the red bars you see going this way. The red bars represent the negative delta. It shows you that there's more aggressive sellers than buyers hitting the bid. Now, let me ask you a question. How successful were all these buyers here? Sorry, sellers, aggressive sellers here, 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 throughout the entire level, that whole level essentially for about 15, 30, 45, 60, 75 minutes, for about an hour to an hour and a half, right? 1, 2, 3, 4, 5, 6, 7, right? You see so many aggressive sellers inside of the key level. Now, with that being said, the key level itself, we were unable to break below the key level, right? And that occurred for, 1, 2, 3, 4, 5, 6, 7 candles in a row, 6 candles before the break, right? What does that tell you, right? So this essentially a fair value gap, a bullish fair value gap, or any fair value gap, if you want to be buying from a fair value gap, it needs to be supported by passive buyers. So what that means is if aggressive sellers could not break below the zone, that means for basic knowledge, there were passive buyers that were present, and those buyers were able to move the price higher. So you want to shift. It's a mentality shift. You want to go from thinking about fair value gaps and support and resistance, or supply and demand. You want to go from thinking this is a support, this is a demand, or whatever. This is a supply, this is a resistance. You want to shift from thinking this is my key level, and I determine my key levels from things like fair value gaps, liquidity sweeps, the basic kind of ICT concepts. You want to come into a key level and you want to see whether it's going to be a demand zone or it's going to be a supply zone. So in this case, it became a demand zone because the sellers had no follow through. The sellers were absorbed, right? All this red delta was absorbed by the aggressive buyers. And that is the only reason, the passive buyers. And that is the only reason the market moved higher, because the market was being supported by the passive buyers, right? So that is why the market shoots up, and that's why the market rallied up. So just to sum this video up, ICT concepts alone will not work, and the lack of success you're seeing is probably because the ICT concepts don't work, right? So try and simplify your trading, try to bring order flow and footprint charts into your trading, and try to understand why the markets move up. And to sum up the video, passive buyers move the market up, and passive buyers drive passive sellers, drive price down.